Well, we all know what the basically all-consuming story of the rest of the week is going to be here, and that is what's going on with the Fed pivot. Because as you guys know, they have another meeting coming up in December, and now people are talking about how this next rate hike is going to be only a half a point instead of 3/4 of a point like it has been, according to Jerome Powell's most recent speech. However, I think it's important we jump into this and discuss it a little bit, because a lot of people might misinterpret what this might actually mean. So let's dive into some of the details of this situation. I'm walking on Allison Island today. It's a super high-end, super fancy island in Miami Beach, and the houses here go for like $15 to $30 million, no joke. So I don't even know if it's worth putting any of them up on the screen. I probably will, just for kicks. I know people can't afford stuff like that, but hey, this is what we're passing by. So might be interesting to just come over here and see something different for a change. Now, the big story about all this is the fact that mortgage interest rates have dropped essentially from 7.3% down to 6.3%. Is that going to convince you to buy? Let me know in the comments if that's going to get you out there. If you are on the sidelines looking to buy, is this all of a sudden going to push you into the buyer's market? Here's the first one. This is what I was talking about. The prices over here are just absolutely redonkulous. This is a brand new house built in 2021. They started off listing this place at $25.5 million. They've cut the price $2 million since March. Haven't been able to sell it yet. Because here's the thing. Lower interest rates for mortgages is undoubtedly going to increase affordability. But by how much? Well, let's take a look at a very simple mathematical example. Since the median house price in many areas of the country is roughly at $400,000, let's just use 400K as a nice round number. This recent rate cut from 7.3 down to 6.3, and remember, for the most qualified borrowers, is going to get you saving about $215 a month, okay? So you're going to go down from like $2,100 to about $1,900 roughly. And that's with a 20% down payment too, by the way. And a lot of people don't put 20% down when buying a home. So that's something to keep in mind. So that's what I want to know from you guys. Is the $200 a month in savings enough to get you out there and say, you know, the worst of it is over, I'm going to go out and buy a house? I really want to know. I'm not being sarcastic here, because I'm trying to get a pulse on what you guys who watch my videos really think about this, because it's important to understand that for me, since I'm the one making the videos for you here, to really gauge where you guys are at with this. And I take this very seriously because I see a lot of comments from people saying, hey Michael, I watch your videos because I'm waiting for you to tell me when is going to be the good time to buy. And first of all, I've already said many times before that, you know, everyone's timing to buy is going to be different depending on your life situation. So there's no one perfect time for any given person to buy. It really depends on you and your life circumstances. However, one thing we're going to have to watch from all of this is how long are these mortgage rates going to stay down? Because this just happened yesterday, Thursday, it's Friday when I'm shooting this. And you know, the way that things have been going with these mortgage rates is, you know, 1 minute it's down, the next minute it's up, and it's very unpredictable. And we saw recently, even though mortgage rates came down before this most recent cut, that mortgage applications still fell. So a couple things we need to start paying attention to after this is how long are these mortgage rates going to stay down for, and at what numbers will they stay at, as well as are pending home sales going to go up? Are mortgage applications going to go up? And those are still two things that we just don't know yet, because this just happened yesterday and the data is always lagging at least a month or two. So we won't even probably know this until the beginning of next year, now that it's December. So, you know, some people think that it's not necessary to, you know, watch daily updates on the housing market, but in this economy, guys, things are changing so fast that I think it's basically necessary at this point, if you're in the game, to really pay attention on a daily basis, because if you don't, then you could be the one basically without a clue on what's going to happen. But to that point, and to be extremely transparent, none of us knows exactly what's going to happen. I don't know what's going to happen. and neither does anybody else on YouTube or anybody else you talk to. We're all just making our best educated guesses based on the most recent information that we get. And of course, sometimes we need to adjust our predictions, essentially, because things are constantly changing. So here's what I think about this. First of all, everyone always looks to Jerome Powell and thinks that everything that he says is gospel. Well, it's not, guys, because he's been wrong. Just like he said, inflation was transitory, and just because he had this speech saying that they may slow down the rate hikes in December, here's what that actually means, because it's important to understand that. The first thing to look at is James Bullard and John Williams are also Fed representatives, and they say that they still need to continue with rate hikes and keep rates at or above 5%. We're talking about the federal funds rate throughout 2023, okay? So they have a say-so in this as well, not just Jerome Powell. That's the first thing. The next big thing is, even if they do pivot in December and they only do a 50 basis point rate hike, what does that mean? It means that interest rates are going up, guys. It does not mean they're going down. It just means that the rate that they're going up is slower than before. Even James Bullard, who just said that interest rates need to be at or above 5% throughout all of 2023, he says this: the speed of the rate hikes is not as important as the ultimate level the rates get to in the end. So I want everyone to remember that, regardless of the Fed pivot or not, doesn't really matter, guys, because their goal is to get the federal funds rate to about 5%, possibly even higher, depending on how things go with the most recent inflation report. And to put that into perspective, right at this moment, as I'm recording this video, the federal funds rate is at 3.78%. So they still have about 125 basis points to go to get to the 5% mark that they're aiming for at the moment. So even if they switch to 50 basis point rate hikes, okay, let's say they do that in December, like everybody's saying, that means they're still going to have to do 2 50 basis point rate hikes and 1 25 basis point rate hikes into 2023, and then hold steady, which means no cutting the rates, no raising the rates until they get more information. I'm telling you guys, I'm cursed with the noise. It's either the landscapers, the FedEx guy, somebody. Try to pick a high-end, supposedly quiet neighborhood, and it's loud as hell. What was I saying? Can't think with all this going on. So now if we look at the Fed's goal of the 5% federal funds rate into 2023, most likely that means we're probably not even going to get to the 5% mark until maybe what, April, May, June, probably midway through the year, roughly, guys. And if we don't get there until the middle of 2023, and then interest rates stay sustained at that level until inflation really starts going down to the numbers that they want to see, that means interest rates are still going to be quite high well into the second part of next year. I'm pretty sure that these 30-year mortgage rates going down that we have seen recently is probably going to be temporary, and if it's not temporary, it probably won't go down much more than it has. So we have to keep an eye on this and see where this goes. But another important thing to remember is that housing is a huge part of the CPI numbers that the Fed looks at, and so housing is still extremely expensive. And with these interest rates, it also makes it even more expensive, and that contributes to inflation being higher as well. And James Bullard thinks that this most recent stock market rally after this announcement is very short-sighted, because he basically said that markets are underpricing the risk that the Fed will have to be more aggressive rather than less aggressive in order to contain the very substantial inflation that we have. So I think a lot of people are probably celebrating this as a victory way too soon, especially stock market investors and speculators. He even said that they may end up raising the federal funds rate to as high as 7%, guys. And definitely no one saw that coming, because that's far higher than they initially anticipated they were going to have to raise rates, but it turns out inflation wasn't transitory and it was a whole lot worse than they thought it was, because not that long ago, just going back to September's Fed meeting, they thought they would only have to raise the federal funds rate up to 4.5 to 4.75%. And now they're realizing that that is probably not going to be enough to get inflation under control, and now it's probably going to have to be at 5% or above. So don't take Jerome Powell's words at face value and just think that his most recent speech means that everything's just going to recover overnight. It's not going to be like that, guys. Another thing they're still trying to get under control is unemployment. They want unemployment to go up. Remember that as well. They want unemployment at 5% by the end of next year. They're also wanting to see inflation to 3.5% by the end of next year, which means that they're still missing their 2% target by 1.5%, and the fight on inflation is going to have to go into 2024. So what is the takeaway from this situation? Well, I think the big one and the obvious one is that this is not over, okay? Anyone who thinks that they saw this interview or this speech from Jay Powell, that this is over, guys, it is not over. We're not even halfway through this fight yet. So to just sit there and say that everything's going to recover and it's all going to be up from here is very naive, to say the least, and means that you're not really looking at the big picture on what everyone involved in these interest rate hikes is saying. So that's why I'm covering this in the first part of this video, because it's extremely important for everyone to understand this, because if you're in the market to buy a house, or you've been thinking about buying or even selling, this will impact you. And the last part of this I want to mention real quick is, if we go back to when inflation was horrible back in the 1980s, the Fed raised the federal funds rate to almost 19%, guys, to get inflation under control. And right now we have a 40-year high for inflation that is as bad as it was back then, if not worse, because the CPI numbers are not the same as they were 40 years ago. The way that they measure inflation is not the same as it was 40 years ago, which was why we can't really trust the CPI numbers that they tell us. So I'm not saying that the Fed is going to raise their funds rate to 19% again, but what I am saying is they're saying they need to get it to at least 5%, and we'll see where it goes from there. And that's still very far away from 19%. So don't underestimate what they may need to do in order to get inflation under control, which is why I don't want anybody to celebrate this too early, because no one knows where this is going to go still from here. And talking about uncertainty, this is something that I covered a few weeks back about Blackstone. Everybody talks about how Blackstone and BlackRock and all these big institutional investors have billions of dollars on the sidelines ready to deploy into housing as soon as the market drops. That's what a lot of people say. I see it all the time in the comments. Well, these guys are in trouble, guys, like I talked about a few weeks ago, and this week is when the first sign of this trouble really started rearing its head up. If you are an investor in the Blackstone REIT, then go ahead and try to redeem some of your money out of the fund. You can't. Why not? Well, because like I said in the last time we talked about this, they have redemption limits, meaning that only a certain percentage of the money invested every single month and every quarter can be extracted from the company. And they have these safeguards in place so they don't end up like FTX. So basically they don't go bankrupt, and they have the money to support their investments and also give their investors a return. And so check this out. Redemptions were going through the roof last month, and that's what led to this situation with Blackstone. And on top of that, the high interest rates that we have is making it difficult, if not impossible, for Blackstone to continue with their acquisitions. Here's what this means that everybody needs to understand as well. When you hear stories like, oh, BlackRock, Blackstone, these guys have $1 billion sitting on the sidelines ready to deploy into real estate, it's not their money, guys. This is money that's given to them through their investors. So yes, even though they pay cash for the property whenever the transaction closes, that cash is not theirs. It's a loan from an investor. So it's basically the same thing as when you and I buy a house, we get the loan from the bank. The bank is the investor in this case, when you're doing it on your own. But for BlackRock and Blackstone, the investor is the public and private equity, people that have money that invest in these companies. And so that's where they get the money from. And it turns out that these guys are in such big trouble that they need to sell their interest in 2 Las Vegas properties at the MGM Grand Las Vegas and the Mandalay Bay in a deal that's worth roughly $5.5 billion. And once this deal closes, it will provide Blackstone a $1.3 billion cash infusion, which they desperately need right now. And on top of that, Blackstone's stock was down 32% in the past year. Just on Thursday alone, it went down 6.5%. So these guys are not doing too great right now. And that's, to me, a very big sign of things to come in the housing market. And just like I was saying earlier, guys, this really quick bear market rally in the stock market and these 30-year mortgage rates going down is just a teaser. It's a teaser from the folks that think it's all over with, okay? But I don't think it's all over with, and I'm guessing probably a lot of you don't either. Because if you're looking at these big picture things, then you realize that there's still a lot more that needs to be happening before this is over. And plus, I'll ask you this, if things are so good right now, why are companies like Blackstone in trouble? Why are their investors trying to pull out money and redeem funds right now? What do you think it is? I'll tell you what I think it is. I think people who invest in Blackstone are afraid right now because the housing market has slowed down to a crawl, essentially. And on top of that, people who invest in this fund probably need the money themselves right now for other things because inflation is making life very expensive right now. So let me know what you guys think about this. Let me know why you think people are pulling out of supposedly these extremely successful hedge funds. And by the way, guys, there's a lot of complainers about institutional investors buying up all these properties and this and that. But just remember, they're able to do that because probably the pension fund you have or your 401k or something like that invests into these hedge funds that ultimately buy real estate. So really, if you want to stop this from happening, stop investing in companies like this because they're getting the money from us in order to buy all this real estate. So you need to remember that as well. I personally don't have any money invested in these things, but a lot of people do, and you might not even know it. And another real estate story that, to me, points to the fact that this is far from over is the CEO of Opendoor just stepped down and is not going to be the CEO no more. They're bringing somebody else in. Well, why do you think that is? Well, could it be because the share prices are down 87% since the beginning of the year? Companies in big trouble. They've lost an ungodly amount of money since the beginning of this year. When I see stuff like that, it's also my gut instinct that kicks in and tells me this is definitely not over because we're only just now starting to see some of the problems and the ramifications from this huge housing market run-up. And since these things move very slowly, I think it's very premature to call it and say, well, it's all over with, mortgage rates are a whole point lower now, and the stock market's going back up. That's not going to be permanent, guys. That's probably going to change. Of course, anything's possible, and it could just continue going up and up forever and ever, and they might turn the money printer back on, and yeah, anything's possible. I'm not saying that couldn't happen, but I'm thinking that the more likely scenario is everything still has further to fall right now. Here's another story to think about. There is a real estate firm in Florida called MV Realty. They have one of these homeowner benefit programs, kind of like we saw the other day where it says, oh, we'll help you buy your next house, or we'll buy your house, or whatever these perks are that these real estate agencies use to try to get people to list with them. And this one, what they do is they offer sellers a cash payment in exchange for exclusive rights to list their property. And sometimes these exclusive agreements can be for as long as 40 years. So you can't list your property with anybody else for the next 40 years in most cases under these terms of these contracts. And basically they give homeowners anywhere between $300 to $5,000 upfront in cash for them to sign this agreement. But the caveat is, if you change your mind and you decide to fire these guys and you want to list your home with another agency, that's when they get you. Because now what they're going to do, they're going to place a lien on your property so that when you do sell it, the brokerage can now collect up to 3% of your home's value when it sells. So this is their way of basically guaranteeing they're going to get the commission from you one way or another by giving you this small upfront payment. And obviously, with the median housing price in Florida being at $400,000 or well above that in a lot of areas, it's more than worth it for companies like this to pay you even $5,000 is nothing to end up collecting that future equity, especially with the fact that so many people are still moving here and real estate prices in many areas of Florida are still continuing to go up, even as they're starting to go down in many other areas. Florida Attorney General has filed a lawsuit against MV Realty for this, saying that the company is preying on unsuspecting homeowners and it locks them into a 40-year obligation designed to siphon away equity from the property, and it's disgraceful. There was an example of a guy from Tampa that signed an agreement with these people and they gave him $879. That was the payment they agreed to give this guy. And in the end, he ended up having to pay them over $12,000 in fees in order to, settle things with them. And basically left him with nothing in the end after the sale of his property. But a representative from MV Realty says that everything we're doing is legal, and once we go through the legal process on this, you guys are going to see that everything we're doing is above board, it's legitimate, and we're not breaking the law. So this will be an interesting thing to follow up on in the future once these people go through this lawsuit and find out who's actually right in the end. And I'm not a lawyer, guys. I'm not in the position to tell you who's right. I really have no idea, but it will be interesting to see, and just something else to be watching out for, because anyone who is going to list your property for sale going into next year, just watch out for these type of gimmicks with these real estate companies, because you could end up getting yourself into a problem that's basically more than you bargained for. Just keep it simple, guys. I mean, list with somebody who doesn't have any of these crazy stipulations, or I'm gonna buy your house if it doesn't sell type of deals. All this stuff is basically a scam, guys. They're gonna scam you in one way or another. The only thing that I can tell you that is normal when you list with a broker is that many times they'll have a cancellation fee in the contract, and that's up for negotiation. In the past, I put mine at only $1,000, because our office leaves it up to us, the agents, of what to put. So I feel like, somebody canceled the listing with me, pay me $1,000 and I'll be on my way, whatever. I don't want to fight. I just want to move on and live my life just like everybody else. But, luckily I never had to get into that with anyone. But if they're going to be making you sign special agreements that beyond the listing agreement, and there's other things to watch out for besides just a standard cancellation fee, I would be very cautious, because this story is a perfect example of just another way you can be taken advantage of right now. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video, and if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.